Welcome back to the Deep Dive. Today, we are attempting a true shortcut to being well-informed, but it involves putting aside the dense economics textbooks and focusing entirely on one variable, the calendar.
That sounds like a radical shift, but it's really backed by decades and decades of data.
Right.
We are diving deep into stock market seasonality, the whole concept that predictable, recurring patterns tied to the calendar year significantly influence market returns and, just as importantly, volatility.
It sounds a little like financial folklore, doesn't it?
It can, yeah.
Yeah.
But when you zoom out and look at, say, 75 years of S&P 500 history, the patterns reveal themselves as surprisingly consistent and critically statistically significant.
Okay, so let's unpack this data. We've pulled historical S&P 500 performance metrics, and we're going to go from 1950 right up to 2024. Our mission here is very specific. We want to identify those statistically robust monthly patterns, uncover the behavioral and institutional forces driving them, and I mean the deep, unfixable forces, and then separate that actionable insight from the fun but functionally useless historical curiosities.
Like the year-end digit patterns.
Exactly.
And that distinction is crucial. Our source material gives us these detailed month-by-month breakdowns of average returns, win rates, all of that. But the core challenge we're facing today is one of modern market efficiency. I mean, in a world dominated by ultra-fast algorithms designed to exploit every tiny inefficiency, why do these simple, predictable monthly patterns still persist?
Are they just relics? Or do they point to something deeper, some underlying market structure that even technology can't fully arbitrage away?
That's the big question. Because if we can understand the why, we get a lot closer to understanding the market's, its psychology.
Okay, so let's start with the basics. What really makes a market pattern seasonal? And why can't we just dismiss it as, random noise?
Seasonality is defined by predictable recurrence. It's fundamentally different from, say, short-term market noise or these very long-term economic cycles.
Okay.
When we observe seasonality in stocks, what we're really observing is the echo of repeated annual human and institutional behavior. It's behavior that is anchored to deadlines.
You mentioned three major anchors or drivers for these effects. Let's explore the human element first, the behavioral factors. How does investor psychology really change just because it's December instead of September?
Behavioral science plays a huge role here. Collective psychology is influenced by the calendar, often, completely unconsciously.
So you're talking about holiday cheer.
That's a big part of it.
Yeah.
Think about the positive sentiment driven by holidays, the collective optimism that ramps up in the final weeks of the year leading into the new year, or even something as simple as the psychological boost from longer daylight hours and warmer weather in the spring. This shift in mood, this generalized optimism, it translates into a higher propensity to take risk and buy stocks. It creates a measurable, predictable buying momentum.
And on the flip side,
conversely, you have the doldrums of summer or the anxiety before a new fiscal year, which can prompt more cautious behavior.
So if behavioral factors are the emotional tides, then institutional behaviors are the predictable mechanical forces, the deadlines, and the required paperwork that moves billions of dollars regardless of anyone's mood.
That's a perfect analogy. Institutional behavior is highly deliberate, and in many cases, it's mandatory.
Okay.
It includes complex tax strategies like tax loss harvesting. This is where institutions or, sophisticated individual investors sell their losing positions, typically near the end of the calendar year, specifically to offset capital gains they realized earlier.
And that creates a predictable selling pressure.
A very predictable selling pressure on certain stocks in November and early December.
And then there's the positive side of that institutional behavior, the famous window dressing.
Exactly. Funds have quarterly and annual reporting periods. Portfolio managers, quite rationally, want their performance report to look as attractive as possible to investors.
Sure. They want to show off the winners?
Of course. So this often means buying up stocks that have been performing well, the winners, right before reporting deadlines and selling the laggards. These buying and selling deadlines create massive, concentrated flows of capital at the end of the year and the end of each quarter, and that directly impacts average monthly returns.
And the third driver you mentioned is grounded in economic reality. The cycles.
Economic cycles align almost perfectly with the calendar, primarily through earnings seasons.
Okay.
We know Q1 earnings will always be reported in April, Q2 in July, and so on. These reporting periods inject major scheduled catalysts into the market. They resolve uncertainty, which often releases pent-up buying pressure.
And the reverse is true, too.
On the flip side, times associated with high vacation periods like August naturally see a reduction in market volume and liquidity. And when volume drops, any news, good or bad, has an outsized effect, which leads to higher volatility and often poor returns.
It's fascinating because these three drivers, psychology, institutional deadlines, and predictable economic cycles, they don't cancel each other out.
No, not at all.
They actually coalesce to create the single most famous market anomaly, the Great Divide, known to everyone as sell in May and go away.
The data supporting the Great Divide is simply staggering. I mean, if you cut the S&P 500's annual performance since 1950 exactly in half, the difference in returns between what we call the weak half and the strong half is massive.
Give us those numbers again, based on the last 75 years of S&P 500 data. Let's start with the weak half, which runs from May 1st through October 31st.
That 6-month span is historically, well, it's anemic. The average return for the entire weak half totals up to only about 1.5%.
1.5% for 6 months.
Yes. That's 6 months of holding risk, 6 months of volatility for returns that barely justify the effort. It's a period dominated by profit-taking, institutional slowdowns, and heightened geopolitical risk precisely because of low liquidity.
But the strong half, November 1st through April 30th, that's where the real capital appreciation happens.
The difference is night and day. The average return for the 6 months from November to April skyrockets to roughly 7.5%.
Wow.
Think about that for a moment. One 6-month period delivers 5 times the total gain of the other 6 months. This isn't just a curiosity. This is a deeply ingrained structural tendency.
I don't think we need to pause here and really quantify that for the listener to move beyond just listing percentages.
Yeah.
What does a 7.5% versus 1.5% difference really mean over 75 years of compounding?
It creates an almost unbelievable divergence. It really does. Imagine two investors, A and B, starting with, say, $10,000 in 1950. Investor A invests only during the weak half, so May through October every single year. The rest of the time, the money's in T-bills or cash.
Right.
Investor B invests only during the strong half, from November to April. By 2024, Investor A, well, they would have grown their $10,000 to maybe $30,000 or $40,000, factoring in volatility and fees.
Okay, not great for 75 years.
Not at all. Investor B, using only the strong half, would see their $10,000 grow into hundreds of thousands of dollars. Depending on the exact compounding factors, it vastly outperforms. The compounding effect just demonstrates that the risk-reward ratio is profoundly skewed toward that strong half.
That dramatic disparity makes you wonder why this anomaly hasn't been completely eliminated,
Right.
especially by the high-frequency traders we talked about. If it's so predictable, why does it persist?
This is the synthesis point, right? The anomaly persists because the drivers are mandatory and behavioral, not strictly valuation-based. Algorithms can arbitrage tiny valuation discrepancies in a microsecond, but they cannot change institutional reporting deadlines. They can't change human holiday schedules. The institutional imperative to clean their books in September for the fiscal year end, or the flood of capital from bonuses and retail spending in December, these are structural calendar effects that override rational pricing for a temporary but predictable period.
So they're, in a sense, unfixable structural rigidities in the financial system.
That's the perfect way to describe it.
That makes the strong half sound like a guaranteed win, but you have to provide context. These effects aren't universal, are they?
Absolutely not. And that's a key point. They are significant tailwinds, not certainties. We have to recognize that the intensity of seasonality varies wildly.
How so?
For instance, global markets often have different fiscal calendars. So while the U.S. might peak in April, a market with a July 1st fiscal year might see a totally different pattern.
And across different types of stocks.
We also observe big differences across asset classes. Small cap stocks, which are often less liquid, they tend to suffer much more dramatically during low volume periods like August and September than the big large cap S&P 500 stocks.
And the research we've reviewed suggests that modern trading has had some effect, albeit a limited one.
It has. Increased awareness of the sell in May strategy and just the sheer volume of algorithmic trading since the late 1990s have definitely muted some of the extreme returns, especially the positive peaks.
So, for example,
Well, for example, while April remains positive, its average return hasn't exploded past 2% in recent decades. But, and this is the important part, the long-term trend, the fundamental dominance of November through April, that remains robust. It's a persistent signal, maybe a little quieter, but still very much present in the data.
with that foundation laid, we can now step inside the strong half and look at the specifics. Let's dive into the peak performers, the months where these behavioral and institutional forces align perfectly.
We're targeting 3 specific months where the market tends to experience maximum upward pressure: April, November, and December. These are the months where that compounding effect we just discussed truly generates capital.
Let's start with the grand finale of the strong half. April. The April effect, sometimes called spring optimism, is historically a powerhouse month. Why is it so reliably strong?
When you look at the raw statistics for the S&P 500 since 1950, April averages a very, very strong positive 1.6% return.
Okay, that's a big number for 1 month.
It is, but what's even more compelling is its reliability. It has a 70% win rate. That means 7 out of every 10 years, you end the month higher than you started.
Wow.
Few months offer that combination of high return and high reliability.
We're looking for causation here, not just correlation. So what mechanisms are converging in April to ensure that high win rate?
It's really a triple alignment of institutional and earnings factors. The first critical factor is earnings momentum. April marks the official kickoff of the Q1 earnings season. And companies, they often use Q1 to set a positive tone for the year. Historically, the market tends to be pleasantly surprised by Q1 reports, which often exceed analyst expectations.
And that immediate resolution of uncertainty and the surge in positive news acts as a major market catalyst.
Exactly. It's a huge one. And the institutional funds are responding to this positive news flow with specific buying actions, right?
Absolutely. This brings us back to window dressing, which is perhaps most intense in April. For many institutions, April 30th marks the end of their first quarter.
So they're tidying up their reports.
They're tidying up. Portfolio managers are actively buying the stocks that performed well during Q1, the winners, to feature them in their reports. This deliberate institutional buying pressure, often aimed at large-cap, high-profile names, provides a powerful and consistent tailwind throughout the month.
It's a cosmetic operation that requires real money movement.
That's a great way to put it. Beyond the earnings and the reports, you also have the fiscal year-end for many Japanese and European entities, which contributes to a global flow of capital.
That's a great point. It's not a purely domestic U.S. phenomenon. The synchronization of these global fiscal deadlines, especially around the start of a new business year in certain major economies, adds to the capital influx.
And what about the behavioral side, the spring optimism part?
Well, on the behavioral side, we do see a documented, though maybe less quantifiable, psychological boost. It's linked to warmer weather, the onset of spring. This generalized positive mood just encourages retail participation and less defensive positioning. People feel better.
Your sources provided some fascinating sector specifics for April.
Yes, and this makes a lot of sense. Sectors that are heavily tied to innovation and consumer confidence, they benefit disproportionately. Specifically, tech and consumer discretionary sectors historically average gains around positive 2% in April, which surpasses the general index.
And that reflects optimism tied to early year innovation announcements and strong consumer data, right, after the winter's over.
Precisely.
But we did note a necessary caveat here. The April effect has been a little less powerful since the early 2000s.
That's correct. While still positive, its absolute dominance has softened. Part of this is just due to the increased interconnectedness of global markets.
How so?
While poor performance in Asian markets or slow European data can now influence U.S. opening prices far more quickly than it could in the 1970s, and the seasonal anomaly is simply not strong enough to override a genuine financial crisis.
Right. It's a tailwind, not a hurricane shield.
Exactly. We have to remember that in April 2008, amidst the deepening financial crisis, the S&P 500 plummeted 8.9%. Seasonality is a probabilistic edge, not a shield against macro disaster.
That sets the stage perfectly for the other side of the strong half, the launch pad, November. This is the month where the year-end rally really begins.
November is consistently the second best month of the year. It averages a positive 1.5% return with a very high 68% win rate. It acts as the market's pivot point, exiting the seasonal weakness and really locking in momentum for the end of the year.
Why November? We've just endured September and the volatility of October. What sparks this immediate and dramatic turnaround?
There are several powerful overlapping drivers. Firstly, and this is a big one in the U.S., political clarity.
The elections.
Major elections, particularly midterms, often fall in early November. And regardless of the outcome, the market despises uncertainty. So the resolution of that political uncertainty, even if it's temporary, it allows capital to flow back into risk assets.
And at the same time, the consumer engine starts roaring.
Absolutely. November marks the formal start of the holiday consumer surge. Black Friday and Cyber Monday anticipation starts driving major capital flows into retail and consumer discretionary stocks.
And you see that in the sector data.
You do. Those sectors, specifically, average a robust 2% gain in November, positioning them for the huge sales spikes of December. Analysts start factoring in strong holiday guidance immediately.
Then there are the massive institutional inflows. We're talking about real money hitting the market.
Correct. The consensus view suggests that institutions re-engage aggressively after the lower volume, more defensive positioning of the summer and fall. They're repositioning for their year-end performance reporting.
And how much money are we talking about?
Well, estimates suggest institutional funds add around $100 billion in fresh capital, or capital taken from defensive positions, annually during this window. This sudden injection of cash provides the undeniable momentum boost needed to kick off the strong half.
This momentum is so predictable that we even have a specific mini anomaly within the month. The Santa Claus prelude.
Yes, it's a detailed observation within the data. The last 5 trading days of November consistently register a mini rally, averaging an additional positive 0.5% return.
So it's the market accelerating into the finish line.
Exactly. It's signaling that the year-end bullish sentiment is already baked in and institutions are fully committed to buying. It's a strong indicator of the sustained positive pressure to come.
Which brings us to December, the month everyone talks about, defined by holiday cheer and that famous rally.
December averages a solid positive 1.3% return and boasts one of the highest win rates, tied with April at 70%.
Wow.
It consistently ranks as one of the top 2 performing months every single year since 1950. It's the culmination of all the positive seasonal factors.
We identified 4 major concurrent forces at work here. Let's break them down, starting with the consumer and behavioral drivers.
On the psychological and consumption side, you have peak holiday optimism combining with massive consumer spending spikes. Retail sales figures jump 20 to 30% above average monthly rates.
And this is concrete revenue hitting the books of major corporations.
It is. It's driving positive outlooks and justifying higher valuations.
And crucially, the workforce gets paid, and that money flows quickly into investments.
Exactly. The flow of corporate bonuses is huge. Estimates suggest around $150 billion in corporate bonuses and profit-sharing payouts flow into employee accounts, typically in the first half of December.
And a lot of that goes right into the market.
A significant portion of that capital immediately finds its way into retirement accounts or investment portfolios, acting as yet another systemic seasonal capital injection.
And institutionally, December sees that dual action, the tax selling wrapping up, followed immediately by window dressing.
This is a fascinating dance. Tax loss harvesting, the selling of losers, often peaks in the first 2 weeks of December. This is the time to realize those losses before the year ends.
Creating bargains.
It creates a temporary depression in the prices of specific, often beaten-down stocks, presenting short-term bargains. And as soon as that selling pressure subsides, the window dressing takes over in the final 2 weeks of the month. Funds buy back their winners to ensure their year-end statements are polished.
We should clarify the true definition of the Santa Claus rally, because it's often misattributed only to December.
That's right. The precise definition, according to market historians, spans a longer period. It includes the last 5 trading days of December and the first 2 trading weeks of January.
So it spills over.
It does. And historically, this 10 to 15-day window averages a robust positive 1.3% gain. It demonstrates that the year-end buying momentum doesn't just halt on New Year's Eve. It confirms the positive outlook for the beginning of the next strong half cycle.
The sectoral impact in December must be huge, especially for retail.
Oh, it's exponential. Retail stocks see huge gains here, averaging a surge of 3.5% in December due to the reported impact of Black Friday, Cyber Monday, and peak holiday spending. But it's also strong for financials and healthcare, which benefit from the capital flows and year-end institutional positioning. The entire ecosystem is geared toward growth.
The strong half November through April is demonstrably the core engine of annual market appreciation. Now we have to flip the calendar and face the challenges of the week half. starting with the quiet, low-return transition period of summer.
The week half, extending from May to October, is characterized by low volume, low returns, and crucially heightened sensitivity to any negative news. The 4 summer months, May, June, July, and August, show a distinct pattern of tepid performance, broken only by a very specific July anomaly.
Let's kick off with May, the famous transition month and the official start of the sell in May and go away tradition. If April is a 1.6% gain, what happens in May?
The market instantly hits the brakes. Average returns just plummet to near flat at positive 0.2%.
0.2%.
Right. The win rate remains slightly positive at 58%, meaning more years are up than down. But the upside potential compared to April surge is almost entirely evaporated. It's a massive shift in sentiment.
What are the primary forces creating this ceiling on price appreciation?
The dominant driver is just profit realization. After that strong November to April run, investors logically decide to lock in those substantial Q1 and Q2 gains. This consistent selling pressure prevents new price discovery.
And volume drops off.
Secondly, institutional trading volume drops noticeably. We see volumes typically reduced by about 15% across major indices as traders start taking pre-summer vacations. Lower volume just means weaker institutional conviction.
We noted that the history of this trend is remarkably old.
It is ancient. The phrase sell in May and go away traces its origins back to 19th century London.
Really?
Yes. Wealthy merchants and bankers looking to escape the heat and, the plague risk of the city would literally vacate London in May and return in September. The sheer loss of capital and activity during those months created a slump.
And it's incredible that a social pattern born in Victorian England still provides a strong predictive signal for modern algorithmic trading floors.
It really is, and the global consistency of this May to October weakness is perhaps the strongest piece of evidence we have for its persistence.
What does that look like?
Global studies show that in 36 out of 37 major global markets, the period from May to October yields significantly less return, usually 5 to 6% less than the winter months. It's a universally observed pattern.
And it affects smaller stocks more.
It does. Small cap stocks, being less liquid, suffer disproportionately in May. While large caps might manage a positive 0.3% return, small caps often lag at positive 0.1%, demonstrating how the reduction in retail liquidity immediately affects them.
So May is the gentle slowdown. June continues that tepid weakness, often tipping into negative territory.
June maintains the slump, averaging slightly negative returns at minus 0.1%. Its win rate dips further to 52%, barely above a coin toss, making it statistically one of the weakest months overall, second only to September.
What specifically characterizes June's difficulty?
Well, you deal with quarter-end portfolio adjustments, but unlike the bullish window dressing of April, June adjustments often involve portfolio managers taking cautious stances, booking whatever gains they have, or just reducing risk as the first half of the year concludes.
And the desks are emptying out.
The institutional desks continue to thin out around the upcoming July 4th holiday. This continuous erosion of liquidity increases the market's vulnerability.
And that low liquidity in June means heightened geopolitical sensitivity.
Exactly. When there's little volume, even sparse, high-profile geopolitical news can cause outsized market moves. The uncertainty surrounding the Brexit vote in June 2016, for instance, caused significant market volatility because institutional participation was already low. It becomes a month where aggressive positioning is usually avoided.
So institutional money is parked defensively, waiting for the first half of the year to officially close.
That's right. But just when we feel settled into the summer slump, July breaks the pattern. The July effect is often described as the summer anomaly.
It's a genuine interruption.
It is. July bucks the week half trend, posting strong average returns of positive 1%.
It's a big jump.
It is. It makes it the strongest summer month by a significant margin, and it maintains a solid 62% win rate. It acts as a significant liquidity and sentiment bridge.
What forces conspire to revitalize the market right in the middle of this summer vacation period?
The first factor is a liquidity bounce. Traders and investors return from the early July 4th break, and they inject much-needed cash and optimism back into the system.
Okay.
But more importantly, the Q2 earnings season kicks off in earnest mid-month. And companies, particularly those in cyclical sectors that benefit from summer activity, like industrials and materials, they often post surprising positive results that lift overall sentiment.
And structurally, we have the Fed meeting.
Yes, the timing of the Federal Open Market Committee meeting is critical. The FOMC holds 8 annual meetings, and the July meeting often falls during a period of perceived low risk.
So they might be a bit more dovish.
Historically, there's a slight tendency for the Fed to provide a dovish signal or some reassurance during the summer to avoid unnecessary volatility, which encourages investors to place new bets.
The sectoral strength in July is quite pronounced, especially post-financial crisis.
That's a key detail. After the global financial crisis, 7 major sectors, including technology and healthcare, have shown distinct performance peaks averaging 1.5% specifically in July. This is likely driven by confidence being restored through earnings clarity.
And it's a global thing, too.
We also observe strong performance globally, particularly in emerging markets, which average about 1.3% returns in July, often tied to shifts in commodity pricing and agricultural cycles.
Unfortunately, that positive energy is short-lived. We crash right back down into the depths of August, driven by vacation overload and those pre-fall jitters.
August is a difficult month. Average returns drop back to minus 0.1%, with a 54% win rate, returning to the low-conviction environment of June. It is the definition of a low-volume, high-risk period, precisely because of the low participation.
How severe is the volume drop in August?
It's severe. Since August is peak U.S. and European holiday time, institutional volumes drop dramatically. We're talking between 10 and 15%.
And when liquidity is that thin?
When liquidity is that thin, the market becomes intensely sensitive to news, or what we call headline risk. Even a minor piece of geopolitical news or disappointing non-farm payroll data can lead to disproportionately large price swings, amplifying volatility across the board.
And institutional focus shifts entirely away from earnings catalysts.
Correct. There were very few major corporate earnings releases in August. The market's structural support is low. Attention shifts almost entirely to the Federal Reserve annual Jackson Hole Economic Symposium late in the month, which, frankly, often generates more uncertainty than clarity regarding future monetary policy.
And funds are already looking ahead to September.
They're already positioning defensively.
So the combination of August and September makes for the weakest stretch of the year.
It does. Our data shows that August and September combined form the weakest duo since 1950, delivering a total average loss of minus 0.4%. It's a period where staying on the sidelines or adopting highly defensive positioning has historically been prudent.
And the risk of a severe drop is very real in August due to that low volume.
We've seen it repeatedly. A classic example is August 2015, when fears stemming from a sudden economic slowdown in China caused the S&P 500 to drop 6% in just a few days. Low volume meant panic-dominated price discovery.
Interesting.
And interestingly, in August, while retail stocks struggle, safe haven assets like gold and mining stocks often see a rise as institutions prepare for the upcoming volatility.
That sets the stage perfectly for the most volatile and statistically significant duo of the calendar, the fall.
These 2 months provide the starkest evidence of behavioral and institutional anomalies. We have the most reliably negative month, followed by the most reliably volatile month. This is where the patterns are statistically the most robust.
Let's start with the September effect. This anomaly is notorious. Why is it so consistently the worst performing month?
September is statistically an outlier, and not in a good way. The average S&P 500 return in September is a dismal minus 0.7%.
The worst of the year.
By far the lowest average return of the year, and its win rate is also abysmal, a mere 44%.
So more years close negative than positive.
Yes, which is a huge deviation from the market's long-term upward bias.
If this is so predictable, why haven't technological advancement or market awareness erased this negative effect? What are the mandatory drivers forcing this consistent pain?
This is the unfixable part of the anomaly. The primary institutional driver is mandatory fiscal year-end selling. A huge number of institutional funds, pension plans, and endowments operate on a fiscal year that concludes on September 30th.
Okay.
So to clean up their books for annual reporting, they must aggressively offload losing positions to realize those losses.
And this selling is mandatory for accounting purposes, regardless of market sentiment or valuation.
Exactly. It creates a massive, consistent wave of forced selling that just overwhelms any positive news flow.
So institutions are essentially required to sell their dogs for bookkeeping reasons, and that selling pressure creates a headwind for the entire market.
Precisely. It's mandatory institutional selling pressure that floods the market with supply. And this combines with the post-summer portfolio purge. Investors who return from vacation often conduct a Labor Day reset, reviewing their portfolios after 2 months of drift and often deciding to lighten up positions.
Adding more selling pressure.
Right. And then you also see geopolitical uncertainty ramping up as legislative bodies return to session after summer breaks, which increases policy risk.
You highlighted that this isn't just an American issue. It's a global institutional calendar effect.
That's the most compelling evidence for its statistical significance. Various research studies confirm that the September effect is observed across over 70 countries and major indices globally. It's an internationally synchronized, systemic, institutional calendar problem.
And it's more volatile.
It is. September is roughly 20% more volatile than the average month.
Yeah.
And small caps are hit hardest, averaging -1% losses, because their lower liquidity makes them highly sensitive to the massive institutional selling we just described.
When we talk about significant drops, September has some devastating historical precedents.
Absolutely. Think of September 2008. Amidst the chaos of the Lehman Brothers collapse, the S&P 500 dropped a catastrophic 9%.
Wow.
And while the financial crisis was the core driver, the pre-existing mandatory selling pressure of the September effect amplified the fear and accelerated the decline. It shows that when fundamentals are weak, seasonality acts as a severe negative multiplier.
After the storm of September, we enter October, which carries the reputation for financial crashes. But the data suggests it's actually a recovery month, albeit a highly volatile one.
October is a study in paradoxes. Its reputation is stained by major crashes, 1929, 1987, the 2008 volatility. But the average S&P 500 return is surprisingly positive. It clocks in at positive 0.8% with a healthy 62% win rate.
So the key characteristic that defines October is extreme volatility.
That's it, exactly. It consistently has the highest monthly standard deviation, typically hovering around 5%. This means that the swings within the month are enormous. You often see sharp, sudden dips followed by equally sharp, powerful rebounds.
So the positive average hides a roller coaster ride.
A huge one.
What initiates the recovery from the September lows and creates that net positive return?
First, uncertainty resolution through earnings. October brings the Q3 earnings reports. This deluge of data finally resolves the uncertainties that plagued the market throughout the low-volume summer and the fearful September. The floor is often put in place once companies provide clarity.
Okay, and second?
Second, we see massive bargain hunting. Following the mandatory tax law selling in September, many oversold high-quality stocks are now trading at temporary discounts, which attracts aggressive buying.
And the behavioral component.
Yeah.
The October phobia itself actually helps create those bargain dips.
Precisely. The fear of October, because of its historical crash reputation, makes many investors overly cautious or quick to sell at the first sign of trouble. This excessive fear often leads to deep, temporary dips,
which are then bought up.
These dips are then violently bought up by sophisticated traders, marking the official end of the week half and the beginning of the Halloween effect, that shift toward the bullish November to April period.
The crash reputation is deserved, but the subsequent rebounds are often forgotten.
They are crucial to remember. After the 1987 Black Monday crash, the S&P 500 staged a fierce comeback. More recently, October 2022 saw the S&P 500 soar by 8%, marking a strong inflection point after a dismal summer and fall.
And you mentioned technology has helped a bit here.
We should note that modern market technology has slightly dampened the volatility. The implementation of circuit breakers since 2000 has decreased the monthly standard deviation by about 15%, preventing those immediate catastrophic freefalls. But October remains the king of sharp reversals.
We've thoroughly covered these statistically robust patterns, driven by institutional calendars and human psychology. Now, as promised, we need to shift gears and apply that critical lens to the anomalies that are fun to talk about, but fundamentally unreliable for actual investment strategy.
It's important to provide this critical analysis for the listener. While monthly seasonality is backed by mandatory systemic annual events, year-end digit patterns often rely on, selective pattern recognition that lacks the rigorous statistical significance required for predictive reliability.
Let's start with the most famous of these numerical curiosities, the historically bullish years ending in 5 pattern.
The historical observation is indeed compelling. Since 1895, a remarkable 92.3% of calendar years ending in the digit 5 have closed with gains for major U.S. indices.
That's a huge win rate.
It is. It's significantly higher than the overall average for any random year, which hovers closer to 2/3. It's a striking data point.
So if the historical win rate is so high, why shouldn't an investor base their strategy for, say, 2025 on this historical success?
Because the pattern has shown significant signs of erosion and failure in modern markets, and, more importantly, statistical analysis just doesn't support a causal link.
For example,
For example, 2015 resulted in near flat or small losses for major indices when you factor in overall volatility. And when serious statisticians analyze the data, they conclude that the difference in performance for years ending in 5, when you account for random variance and market noise, is not statistically significant enough to be considered a reliable, isolated predictive edge.
so it's an interesting historical artifact, but chasing it is essentially betting on chance.
That's exactly right.
And then we have the observed weakness in years ending in 0.
Years ending in 0 are historically weaker, and they fit into a cyclical pattern of market difficulty. The general observation is that these years often begin poorly, sometimes with a sharp decline in January. They struggle through the mid-year, and only manage to finish with very modest gains in December, if they finish positive at all.
And this weakness is often attributed to the end of a long expansion cycle.
It is. This feeds into the broader, suggested 10-year market cycle analysis that many amateur chartists adhere to.
You mean the idea that the market peaks in years ending in 9 minutes, struggles in Oldham 1?
Yes, exactly. The theory suggests that the market peaks in the years ending in 9 minutes, struggles in years in 1, bottoms out in year 2, and then begins a sustained rally that accelerates toward the next peak in year 5.
It's a clean, symmetrical model for market history.
It is, but it relies heavily on correlation, not causation. It conveniently connects major historical events like the start of the dot-com crash in 2000 or the 2008 crisis, but it fails to account for the unique economic drivers of each period.
So what's the final crucial takeaway regarding digit-based patterns for our listener?
The consensus from the sources is clear. These patterns are unreliable. They often reflect random chance or the human desire to find order in chaos-selective memory, highlighting the years that fit the narrative while ignoring the others.
So don't trade based on the calendar year number.
Right. For investment decisions, the focus must remain on broader fundamental factors: corporate earnings momentum, inflation trends, monetary policy decisions, and genuine geopolitical risk. Relying on which digit the year ends in is a form of financial superstition.
That's a critical distinction to make between systemic behavioral calendar effects and random historical alignment. We've covered a lot of ground, moving from the most robust patterns to the most questionable. Let's bring it all home and synthesize the key lessons.
We started by asking if seasonal patterns are still relevant in the age of algorithms. Our analysis of the 1950 to 2024 data confirms that the underlying behavioral and institutional mechanisms persist, making these monthly patterns valuable contextual signals.
So if the listener only takes 3 things away from this deep dive, what are the most powerful, actionable lessons? First, the sheer power of the November to April strong half.
Remember the scale of that discrepancy. 7.5% average return in just 6 months, capturing the vast majority of annual gains. This window is structurally supported by tax flows, holiday bonuses, window dressing, and reduced political uncertainty. If you are going to be aggressive with capital deployment, that is historically the time to consider it.
Second, the consistent statistical underperformance of September.
The average loss of minus 0.7% and the 44% win rate makes September an undeniable statistical outlier. This is driven by mandatory, synchronized, global institutional fiscal year-end selling. It is a predictable annual hurdle that the market struggles to overcome, regardless of how efficient trading becomes.
And finally, the nature of October as a recovery month, defined by high volatility.
Never fear October's reputation, respect its volatility. The average return is positive at 0.8%, but the monthly standard deviation is the highest. This tells you to expect deep swings. The dips caused by Octoberphobia and uncertainty resolution are often followed by sharp positive rebounds, signaling the start of the next bullish cycle. It is a contrarian's battleground.
These insights provide a powerful probabilistic edge, but as we concluded, they are not foolproof. What's the final word on applying this knowledge?
Always remember that seasonality is a secondary factor. It must be used alongside critical, fundamental analysis. If valuations are stretched, if inflation is accelerating, or a major geopolitical conflict erupts, seasonality will be swiftly overridden.
So use it for timing.
Use these patterns to inform the timing of risk deployment or risk reduction, but never as the sole reason for a trade. And always, always maintain diversification.
Perfect advice.
Yeah.
And to leave you with a final provocative thought that builds on what we've learned about September.
Given that the September effect is statistically significant across over 70 countries and has persisted for nearly a century despite universal awareness and the rise of ultra-efficient financial technology, we have to ask, what deep-seated annual institutional or psychological behavior is so powerful and universally applied that it consistently overrides billions in rational trading capital for an entire month, year after year, globally?
It suggests that the calendar, rather than fundamental value, sometimes determines collective institutional action.
A bias so entrenched that even the sharpest algorithms cannot correct it.
Food for thought as you map out your investment calendar for the year ahead. We'll see you next time on The Deep Dive.